The escalation between Israel and Iran has become a key trigger for global markets. Following reports of military strikes, investors immediately priced in increased geopolitical risk. Oil prices rose, stock indices increased volatility, and demand for safe haven assets grew. We examine how the conflict in the Middle East is affecting oil prices, the global economy, and the scenarios the market is pricing in. What happened and why it matters. Reports of strikes and the threat of retaliatory action have heightened concerns about the region's stability. The Middle East remains a strategic center for global energy, and any military risks near export infrastructure are automatically reflected in oil prices. Markets are sensitive not only to the event itself, but also to the likelihood of supply disruptions, shipping restrictions, and expansion of the conflict. Even if physical supplies are not yet disrupted, investors add a so-called geopolitical premium to the price. Oil reaction. The main crisis indicator. The key benchmark is Brent prices. Historically, during a regional escalation, the market factors in an additional risk of $5 to $10 per barrel. If threats affect the Strait of Hormuz or export terminals, the rise could be significantly stronger. Oil is not trading today, nor are defensive commodities. However, oil company shares on the Moscow exchange responded with a rise of up to 2.5%. Why oil is rising? Risk of export disruptions. Rise in shipping insurance premiums. Speculative demand from traders. Reassessment of the global supply and demand balance. For businesses, this means an immediate increase in transportation costs, production costs, air freight prices, pressure on margins. Scenario forecast for oil prices in 2026. The market is currently pricing in 3 basic scenarios. De-escalation, 35% probability. Limited exchange of blows. Rapid diplomatic cooling of the conflict. Oil supplies are not disrupted. Brent price range, $60 to $65. The effect is short-term volatility without systemic inflationary pressure. Baseline scenario, 45% probability. Tensions persist. Supplies are not cut off, but risks remain. Risk premium remains in the price. Brent price range, $70 to $80. This is the most likely scenario for the coming months. For the global economy, this means moderate inflationary pressure and high market volatility. Negative scenario, 20% probability. Expanding conflict. Threats to shipping. Real supply disruptions. Brent range, $90 to $110. In this case, a surge in global inflation, a review of central bank policies, and a correction in stock markets are possible. Stock market reaction. When geopolitical tensions rise, investors traditionally reduce their stock positions, move into gold and bonds, strengthen dollar assets. Particularly sensitive to conflict are airlines, tourism, industry, emerging markets. If oil consolidates above $80, pressure on global indices may increase. Inflation and monetary policy. Rising energy prices directly impact inflation. Fuel prices rise. Logistics costs increase. Production costs increase. Consumer prices rise. Central banks find themselves in a difficult situation. A slowing economy and persistent inflationary pressures limit their room for rate cuts. What does this mean for business? With oil prices above $75, companies should recalculate their financial models. Key actions: update fuel cost forecasts, strengthen liquidity control, diversify suppliers, consider hedging commodity and currency risks. Companies with high energy intensity are particularly vulnerable to the current turbulence. The conflict between Israel and Iran is not only a geopolitical issue but also a global economic factor, which is already influencing oil prices, inflation, stock markets, business strategy. In the short term, oil remains the main indicator of the situation. Currently, the market is assuming a baseline of $70-$80 per barrel, but if the conflict widens, the range could shift to $90 plus. Businesses and investors should prepare for a period of increased volatility. 2026 could be the year when geopolitics once again determines the dynamics of the global economy.